Hello and welcome. My name is Kyle and this is going to be a video tutorial going over problem S16-10 from the Pearson text. So allow me to share my screen. I've got the problem ready to go for us right here. So on March 1st, 2019, Burr Incorporated paid $1 million to acquire a 35% investment in Mint. After 1 year, Mint reported net income of $250,000 for the first year and declared and paid cash dividends of $55,000. Record the following entries in Burr's General Journal. So we need to record the purchase of the investment, the proportion of net income on February 29th, 2020. Look at that. It's a leap year, 2020. They've incorporated that into the question. And then the receipt of cash dividends on March 1st, 2020. First thing we need to establish in this problem is what method to account for this investment with. I've included here a decision tree that we can use. This decision tree first allows us to distinguish, or first forces us to distinguish whether it is a short-term or long-term investment. Now, if it's a short-term investment, that generally means they will be purchasing and selling it within a 1 year period, within 12 months. If it's long-term, it is beyond 1 year. In this problem, it tells us after 1 year, Mint Limited reported net income. So they've at this point already held it for 1 year's time, which to me tells me it's going to be a long-term investment. Then what we need to do is determine whether or not they have significant influence. If they have significant influence, we use the equity method of valuation. Now, we're given this general guideline, 20 to 50%. Why is there a guideline here? It's because you need to use judgment in determining whether there or not there is significant influence. In this problem, they have, 35%. They've acquired 35% of another company. That's well within this 20 to 50% guideline. So we're going to use the equity method of valuation to solve this problem. But the reason that there is a range here is because maybe this organization, Burr Incorporated, owns 35%, but maybe there's another shareholder, and that other shareholder owns 65%. If the other shareholder owns 65%, that other shareholder has control, which means that any other shareholder cannot significantly influence the organization. But here we're not given any other information about any of the other shareholders, so we're going to use the equity method of valuation. So the very first one, the purchase of investment. This investment was made on March 1st, 2019, so I'm going to date my journal entry accordingly, and they paid $1 million. So regardless of the method, regardless of whether we're using the fair value method or the historic cost method or the equity method, the actual journal entry of acquisition is going to be the same. It doesn't change until later on. So the journal entry for the acquisition of this is to debit an asset account. The debit is going to be the investment in Mint Limited common shares. This is an account title that has common shares in it. Common shares we know is an equity account. However, in this context, this is actually an asset account because we are investing in another company. It's another company's equity that we are investing in. So from the perspective of Burr Incorporated, it's an asset. And we record it at cost, which is going to be $1 million. So we've got our debit established here, and of course we pay for we paid for this. We paid $1 million, so cash needs to go down, and I decrease my asset with a credit. So we have a debit to an asset account and a credit to an asset account. So on acquisition of this investment, overall assets are unchanged. Then point 2 here is Burr's proportion of net income on February 29th, 2020. Again, there's typically 28 days in February. There's 29 days in this problem, which means that 2020 was a leap year. Okay, so their proportion of net income, this is where we need to determine what method we're using. And it tells us to use the equity method of valuation. Now, it's called the equity method because this is also going to increase the equity of this organization, of Burr Incorporated. Now, let's see, they reported net income of $250,000. This is their overall net income. What we need to figure out right now is Mint's proportion of that. And Mint's proportion is 35%. They acquired 35% of this organization. So I'm going to say their claim is 35% of the other organization's net income. So I'm going to multiply these two together. That gives me 87,500. But from a journal entry perspective, what do I do with this amount? Well, I'm going to debit my asset account. I'm going to debit this investment account, debit my asset account. My investment earned $250,000 in total of net income. Of that, Mint or Burr Incorporated owns 35% of that net income, or 87,500. So I've got my debit here. What do I need to do for my credit? I'm going to credit an equity method investment revenue account in that amount, and 87,500. So you might wonder, why am I doing that, and why is this called the equity method of accounting? Well, let's look at the fundamental accounting equation. Fundamental accounting equation is assets equals liabilities plus equity. That's owner's equity if it's a proprietorship, shareholders equity if it's a corporation. We're dealing with a corporation here, so this is going to be shareholders equity. Now, shareholders equity can be further broken down. It can be broken down into, well, investment of common shares minus dividends. Whoops, I'm sorry about that. Minus dividends. So it's a combination of these direct to equity accounts, or it's a combination of accumulated net income. And for a corporation, net income accumulates in what is called retained earnings. Now, retained earnings, of course, is accumulated net income minus dividends. So an accumulated net income minus dividends, of course, means that retained earnings is a function of then revenues minus expenses and minus dividends. So when revenues go up, retained earnings go up, shareholders' equity goes up. And we've already seen here that we debited the investment asset account. So it's called the equity method of investment because it increases this organization's equity at the same time. We're crediting this revenue account. That's going to increase revenues, which increases net income, which increases retained earnings, which increases shareholders' equity. And we know this equality always has to be true. We already debited the investment account. So we're crediting this equity method investment revenue account. And then this third component here, receipt of cash dividends on March 1st, 2020. Receipt of dividends, we need to be careful about whether we're treating these dividends from the issuer perspective or from the receipt perspective. Here, this is the receipt of dividends. So cash for Burr Incorporated is going to go up. Cash is going to go up, which means the investment of the organization in Mint Limited common shares is going to go down. Okay, so I'm gonna touch on that in a minute. First, I'm just going to complete this journal entry and then explain why. So let's see. For the first year, after 1 year, Mint Limited reported net income of $250,000. We've dealt with that here. And then declared and paid cash dividends of $55,000. So total dividends were $55,000. Now, Burr Incorporated does not have claim to all of these dividends. Instead, they are only going to be receiving 35% of them. So they're going to receive as cash $19,250 in dividends. Okay, so their cash is going to go up by 19,250. But let's think about why we're lowering this investment in common shares account, why we're lowering this asset account. Well, one, we're increasing our assets, we're increasing cash, we're decreasing this investment, so overall assets are unchanged. But let's think about the payment of dividends from from Burr's perspective. The other company, and this other company is Burr. When they declare a dividend, they are going to lower retained earnings and credit this dividend payable account. And then when they actually go, the total amount for them is going to be what? 55,000. And then when they go and actually pay that dividend, they're going to lower their dividend payable to zero and lower cash. So from Burr's perspective, Burr's equity is decreasing. So we're going to actually lower our asset amount because the equity in the other organization has decreased. So hopefully that makes sense. Okay, so this is problem S16-10. I hope that you found this tutorial useful. If you have any questions, please feel free to reach out to me. Otherwise, have a great day. Take care.